Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So, the big brokerage firms I worked for 18 years. Big firms, regional firms. I worked for them for 18 years, and the mantra always was sell the relationship, not the performance. And in the beginning, it wasn't very focused that way because it was a transactional business. It was earning commissions, buy and sell, one buy, one sell at a time. But as we moved to a fee-based situation, the idea was to sell the relationship, not the performance. Make them like you. Make your clients like you. So what do you think that is? What do you think that is? What is it that they're selling? And yes, indeed, they're selling. Do you really feel confident in the returns you're receiving? 2019 was up between 25 and 30%. How'd you compare? 5%? 10%? 15%? 20%? Do you know how you did? If you knew how you did in that range, why do you accept that? Why do they downplay performance? Why do the big firms and even the RIAs, why do most financial advisors downplay performance? Is it because they're saying they're reducing risk? If you're not getting 25 or 30% in 2018, or an average of 12% for the last 10 years, you know what you're paying in performance to reduce risk? And they'll say it's to reduce risk. They'll make the pyramid to show that you have safe things. Or they'll do the asset allocation to show that you're safer. So if you're looking at a 12% return, that takes 100,000 to 310. But if instead you're getting 8% when the market is up 12, and I'm looking at over a 10-year time period, it takes 100,000 to 215. So in the last 10 years, if you'd invested 10 years ago 100,000, you'd have 310,000 if you'd received 12% on an annualized basis. But if you're only getting 8% on an annualized basis, that 100,000 would have only grown to 215. So you would have paid $95,000. Start with 100,000, paid $95,000 just to reduce the risk. That's $9,500 per year on the average. That's 9.5% of your original investment to reduce risk. 2019 was a special year. You can do the same analysis if you were getting just 20% instead of 25%. It's much worse if you were getting 15% or 10% or 5%. Do you know what you're paying to reduce the risk? You need to ask your financial advisor. If you're getting 5% versus 12%, it's even worse. 5% over the last 10 years would have taken 100,000 to 162,000. That's 15,000 a year on a $100,000 investment. 15% to reduce the risk. And I would guess the financial advisor doesn't know because they're listening to the firm that tells them sell the relationship, not the performance. Uncorrelated assets, asset allocation, it's all about that. In real estate, the question is location, location, location. That's what they tell you. In securities portfolios, the mantra is also don't lose money, don't lose money, don't lose money. But you're paying for that. How much are you paying? To avoid being down 10% in any one year, are you willing to pay 9.5%? To avoid being down 34%, in 1 out of 10 years, are you willing to pay $95,000 to $150,000 on a $100,000 investment? That's what you're giving up. That's what you're giving up to reduce short-term risk. My clients don't accept that. I believe my clients want more than lower risk and higher returns. They're really hoping for wealth. I have a passion for creating wealth and maintaining that wealth. My clients have often worked hard for their investment dollars. They own their own business or a position within a company or an inheritance. It's not just if you're doing well in a job and being promoted, if you're doing well in a business and growing. You don't want to be just average. You don't want to just be mediocre. You want to be good. And that's what my clients want. They don't want any thought of poverty either. Many have experienced poverty. I've experienced poverty. I've experienced being poor. Many have built a business from scratch during those early years. They know what it's like to try to put food on the table. It's been a difficult time, but when you achieve success, you don't want to see poverty again. 2008 raised fears for a lot of those people, but I don't believe my clients had any of those fears. I used to get about one call a quarter during that time period of 2008, 2009, and those calls were primarily to ask, are you doing okay? Are you surviving all this? I didn't have but one or two clients that were really concerned about their accounts, and those were mostly new clients who hadn't experienced that. I believe that my clients don't want to have poverty. They don't want the fear of being poor again. And along with that, I believe my clients want to win. I'm intensely competitive. I want to beat the market. I work at that very, very hard. And I believe my clients are there. They started their own business, or they climbed the corporate ladder. They played golf or chess or sports. It's being in a winning situation, intensely competitive. Being average is not enough. Being mediocre is not enough. They want to win. And I believe in that respect, my clients want to beat the market. They want to win. Charles Ellis wrote the book, and it's been followed by any number of other businesses saying to expect to underperform the market. Expect to have a diversified portfolio, one that underperforms. I don't believe my clients want that. It's not about the relationship. It's not about being up 7% when the market's up 11. It's not about being up 15% when the market's up 25. It's not about being up 2% when the market is up 5. My clients want to do better. And I want to be hired by my clients. Oh yeah, I have some good friends and some relatives, but it's not about the being liked. It's about performance-based relationship. My clients pay me a lot of money. Make no mistake about it. I get paid very, very well. And that means I've been hired to do a job. And I believe that my clients want to feel the pride when their accounts perform well. And they have over the years. Some recommend and refer me to friends, not because they like me, but because they know how I do. You know, one of the problems that faces a lot of my peers is this whole thing when a parent dies. The children usually move their accounts to their own broker. Time and again, I've had the parents that die. The children get to see how the parents have done, and the children bring in their accounts, bring them to me. They get to see what their parents have done compared to what they're doing, and so the children bring their accounts in. That's unusual for my industry. I have clients that are third generation clients. It just passes from one down to the other. And the final thing is my clients don't want to leave anything for the U.S. government, because when they do pass away, they have a choice of who they leave their money to. Do they leave it to children or grandchildren or great-grandchildren, nephews, nieces, employees, or others? Or do you leave it to the U.S. government? Most, if not all of my clients, want to leave nothing to the U.S. government. They've already given a lot of money to the U.S. government. Enough is enough. So they want more than higher risk or lower risk and higher returns. They want more than a computer printout. Their concerns are deeper and stronger. They want to win. The big brokerage, when I worked for them, it was all about selling the relationship and not the performance. Make them like you. Why do you think they're selling that? Because, yes, they are selling, and they want you to feel confident in your financial advisor. But in 2019, when the returns were up 25 to 30%, how did you do? I asked the question at the beginning of the program, how did you do? 5%, 10%, 15, 20? Do you really accept that? Do you really accept the fact that you could be paying 9.5 or 15% average for your insurance of not a short-term loss? 9.5 to 15%. That puts it in real terms. You should think about that. You should know that. You should ask that question, because that's a real amount that you're paying somebody just to keep short-term losses away. Is it realistic? Is it worth it? For my clients, they don't think so. For me, I don't think so. I want to do better than the market over the long run. I want to create and maintain wealth. That's where we are. We're coming to a commercial break. Don't go away. I'll be right back after this and talk about traditional financial planning, what's wrong and why we don't do it, why we do future planning.
About money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So welcome back. I've been talking about investments. I want to continue to talk about investments, and I want to talk about financial planning. I don't do financial planning. I do what I call future planning. So why don't I do financial planning? Well, I'll tell you, there's a lot wrong with financial planning. Start with this. Financial planning is about the future, and no one has a crystal ball. You have to make some assumptions about the future, and assumptions are like predictions, and financial plans are geared to do that. And one of the tools that they use with traditional financial planning is Monte Carlo simulation. The idea is to say, what is the probability you're going to have enough money for the rest of your life? Makes sense, doesn't it? What's the probability? If you have a 95% chance of having enough money for the rest of your life, isn't that good? If you have only a 20% chance, don't you need to take some corrective action? That's the idea. Monte Carlo simulation's been around a long time. It's based on mathematical formulas, and you see it on not just financial planning, but in a number of additional forecasting methodologies for different areas. But the Monte Carlo simulation assumes the normal distribution. The normal distribution is that bell-shaped curve, the almost upside down U. And the center of that curve is the average. Mathematically we call that the mean. But it's the average amount. Half of the probabilities are above the average, and half are below. Half what are called observations, half the points are above, and half are below. And then a very nice thing is to calculate what's called the standard deviation, because that means of all the possibilities that come out, 66% are going to be within plus or minus one standard deviation. It's a mathematical formula. 66% of the time, you're going to be within one standard deviation, plus or minus. How big that standard deviation defines the curve around that. 95% within two standard deviations. So if you have a 95% chance of having enough money for the rest of your life, that means you're way out 2 standard deviations above the average of what you'd expect. Now, 3 standard deviations is 99%. So if you get 3 standard deviations above the average, you have a 99% chance of having your money, assuming that everything else is correct. So that's the mathematical approach to this whole thing. The question is, does it work? I've used this example before, but I want to go back to October 1987. October 19th, 1987, that was the crash. Remember? The crash, the market went from 2,300, it sank by 508 points. Went down over 30%. So remember, 1 standard deviation on the negative side is 34%. It's spread around. 2 standard deviations, 95, 3 standard deviations, 99. Only 1% of the time should the market fall so far that it gets beyond 3 standard deviations. So what was the 1987 crash like? Vinod Kashkarian calculated it. 20 standard deviations. 99% falls within 3. This was 20 standard deviations. What was the probability that would happen? It was 275 chances in an octo-vigen trillion times. I'd never heard of that number before. An octo-vigen trillion is a 1 followed by 87 zeros. 87 zeros. 1 trillion is 1 followed by 12 zeros. An octo-vigen trillion is a 1 followed by 87 zeros. The probability of a crash in 1987 is so far off the charts, they don't even make charts like that. Given that 1987 was unusual, then what about a 20% drop? How often should that happen? Well, based on the normal curve, it should only happen once in every 111 years. If Monte Carlo simulation is right, we've been through the crash of 2008, we shouldn't see that happen again, at least for another 111 years, if Monte Carlo simulation was right. Nor should we have seen it since 1909. Think about it. Or actually, 1899. 1887. Okay. But we saw it in 2008. We saw it in 2000 to 2002. We saw it in 1990. We saw it in 87. We saw it in the 70s. We saw it in 61. We saw it in the 50s. We saw it in the 40s. We saw it in the 30s. Oh, yeah. Far more often than once every 111 years. Obviously, what we're seeing in the stock market is not a normal distribution. It's not at all a normal distribution. And if it's not a normal distribution, then Monte Carlo simulation can't be right. And since the 1800s, we've known that the normal distribution is not right. Now, the normal distribution, that bell-shaped curve, is a very nice curve, and it's part of a family of curves. It's called, in mathematical terms, it's called the Gaussian distribution. And it's part of a family called the Cauchy distributions. They're all that kind of bell-shaped curve, but some are flatter, some are thinner, and they have different properties. So when 2008 came around, and mathematicians and research people realized that Monte Carlo simulation didn't work and that the market was not a normal distribution type of market, they decided to modify. Instead of using the normal distribution, that Gaussian, what the mathematicians call the Gaussian distribution, they decided to do a fat tail, giving a lot more room on the outside of that curve and flattening the curve. So it's like an upside down U where you pull the two sides of the U out and you get them way out so it looks like you've got a bump. You know, I'm a mathematician. I love all this stuff. So you give a heavier weight to the market when it drops, and you think you solved the problem. The question is it a good predictor? Nah, it doesn't work. We live in a dynamic world, and things are not always the same. Think about it. 160 years ago, agriculture was 81% of the U.S. export market. They didn't even have airplanes. They didn't have buses. They didn't have cars. They didn't have TVs. They didn't have radios. They didn't have telephones. They didn't have restaurants like we have restaurants today. They didn't have radio stations. They didn't have any of that. You know, the industries 160 years ago were very different. The industries 130 years ago were very different. And those all make exceptions to what's going on. Companies are different today. We live in a dynamic world. And in my opinion, there are some things that remain constant. The market is driven by earnings, but the earnings are generated in different ways. And there's no way to aggregate that into an annual distribution that follows a fat tail or a Cauchy distribution, a normal distribution, or a chi-squared distribution. And those are all different curves. And yes, I like to play with the mathematics, but Monte Carlo doesn't hold. So we're back to the fact that financial planning is still looking forward into the future. But there's another issue with the whole thing as well. You know, it's what I call garbage in, garbage out, Geigo. You assume that tomorrow is going to be just like today, and just like the last 10 years, and just like the last 50 years. So you can learn some general themes from the past, and I say that history doesn't repeat, that it rhymes, so there's some things that you can learn from the past. But not the way financial planning solves it. They use historical records to forecast the future. The average stock return from 1928 to 2014 was 10%. Or if you look at it just from 1984 to 2014, it was 8%. Or 7% if you listen to Warren Buffett. So it depends upon where you start your data from and where you end it. And it's an assumption saying that tomorrow is going to be like today. Tomorrow is going to reflect the same thing. And that's in the bond market, that's in the stock market. And taking interest rates, you assume that interest rates are going to be relatively constant. You're assuming that inflation is going to be relatively constant. You know, right now we're seeing inflation of 1 to 2% right now. In the 70s, we saw double-digit inflation. And in the past 10 years, we've seen inflation at 1% or lower. So how do you forecast that into the future? What kind of assumption do you make? Do you forecast that we're going to have a high bout of inflation? If you do, you have a problem. If you forecast that it's going to be constant and based on what we've seen the last 100 years, that's an issue too. We live in a dynamic market. We live in a dynamic market for what the stock returns are going to be, earnings are going to be, companies are going to do. We live in a dynamic market for what inflation is going to do. Forecasting into the future. When you look into the future, saying that the future is going to be like the past, it may be some way to adjust forward, but not a very good one. We're going to come into a commercial break. Don't go away because I want to finish this idea. It's important to understand, and I'll be right back after the commercial break. Don't go away. We've got more to come.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the difference between traditional financial planning and future planning. Now, I haven't gotten around to talking about future planning. I'm still talking about what's wrong with financial planning and why I don't do financial planning, why I use something I call future planning rather than financial planning. So let's get back to financial planning. Let's get back here. When you think about the returns, when you think about what you're doing with financial planning, you're forecasting into the future. You're saying, this is where I expect the markets to go. This is what I expect inflation to be. This is what you need to do in terms of your saving to meet those end goals. I talked about Monte Carlo simulation. That just doesn't work. That just doesn't work. We learned that lesson in 2008. We saw that it does not work. It doesn't hold up. But we also saw in 2008 that the averages don't hold up. I mean, if you look from 1980 to 2000, the market increased at an average rate of 17.4%. If you go back and say, we're in a really good time, we're going to forecast for the next 30 years, through your lifetime. If you're 70 years old, you're going to live for another 30 years. Maybe you're going to live for 40, 50 years. 17.4%. Would you use that as a rate? No, probably not. Would you use 8%? Would you use 6%? Historical numbers. Those are all assumptions. Those are all assumptions. You have to assume that the market is going to be reflective of what it was before. Or you just have to make a gut guess. How do you plan with a gut guess? One example that I use sometimes for planning, and it's an exaggerated example. It's meant to be exaggerated so we get the time frame really compressed. And this is a person who has $100,000 and they need $20,000 from their investments to meet their living goals. The rest are covered. And, it's an example, so don't ask me about the rest of the details. They need $20,000 a year. They've got $100,000 they start with. They've invested in the stock market. The market goes up 20%. So at the end of the year, their $100,000 has grown to $120,000. They're able to take $20,000 out, still have the original principal of $100,000. Second year, same thing happens. The market continues its upward trend, generates another 20%. So that $100,000 in the second year grows to $120,000. They're able to take $20,000 out. Life is good. The third year, they start with $100,000, but this year, instead of going up 20%, the market goes down 20%. And at the end of the year, they have $80,000. And now when they take the $20,000 out, they're left with $60,000. Now to get back to the $120,000, so that they'll have their original investment plus take out $20,000, that market has to double in value. So that's a very exaggerated example, but it gives the concept that you have a margin in there where you have to look at what you can take out and not take out. Now, there have been a number of studies that have been done over the last 10 or 15 years that show that even taking 4% out of a portfolio does significant damage to the portfolio. Not in 3 years like I just illustrated, but over a long period of time, 15 or 20 or 30 years. Going back to the 1960s, there was a financial advisor, call them stockbrokers in those days, we were called. Back in the 1960s, it came up with, or 80s, came up with the idea that 4% was a reasonable amount to take out of a portfolio and still have the portfolio continue to exist into the future. Those assumptions now are questioned, and people are saying less than 4%. That's because performance is so bad. But that's another issue that I talked about earlier in the program. Performance is bad. 4% is too high. But if you're looking at financial planning, you're looking at moving forward for a significant amount of time. And you have to consider not only where you're going, but how much you're taking out. Which brings me to the third point of what's wrong with financial planning, and that is performance. It's what I call 10 is the new 4. $100,000 in income or $100,000 investment at 9% over 30 years, well, if you save just 4%, if the market's returning 9%, the market's returning 9% and you're saving just 4% of a $100,000 income, over 30 years, you'll have put away $1.66 million. And that allows, with a 4% withdrawal, $65,000 plus Social Security is going to get you back to essentially close to your $100,000 or 90% of it. Over 40 years, with a 9% return in the stock market, taking only a 4% of a $100,000 salary is going to put you at $2.83 million. And at 4% withdrawal rate gives you $113,000 plus Social Security. But there's a couple current issues. 4% is too little to save, and people are talking about needing to save up to 10%. So why? And people are talking about cutting withdrawal rates to 2 to 3%. Why? So there's an example that I use to show the math, why 10 is the new 4. So if you go into a store and you want to buy a $10 item and there's an 8% sales tax, and the clerk says to you, to buy that item, I can do one thing. I can give you the discount before the sales tax. I can give you a 10% discount, so you pay only 9 plus 8%. Or I can give you a 10% discount after the sales tax is added on. What would you choose? Most people, almost off the top of their head, say, I'd choose to take it before the sales tax, right? So if you take it before the sales tax, so $10 less 10% means you'll pay $9. And 8% of $9 is 72 cents. So the total you'll pay for that item is $9.72, right? Okay, everybody's doing the math. You've got your pencil and paper. You've done it. So think about this. So suppose instead of taking the 10% discount before the sales tax, you take it after. So you buy the $10 item. They add 8% sales tax, so the total is $10.80. And now the clerk's going to take 10% off $10.80. And 10% of $10.80 is $1.08. You're following my math? You should be following the math. The total, if you take $1.08 off $10.80, is $9.72. That's exactly what we got if we took the 10% discount before the sales tax. So does it make any difference if you take the 10% discount before the sales tax or after the sales tax? No, it makes absolutely no difference. And the reason is because math has a property called commutative. So that gives you a little background as to why I say 10 is the new 4. Back to portfolio construction. If the return is 4% instead of 9%, and a lot of people are underperforming the market, they're getting 4 or 5 or 7% less than what the market's doing. If the return is 4% and the average return on the stock market is 9%, then you need to save more. If the return is 4%, you need to save 9% or round it up to 10. If the return on the market is 9%, you only have to save 4%. Are you following what I'm saying? This is back to the clerk and before the sales tax or after the sales tax. If you're getting 9% in return, you only have to save 4. If you're getting 4% return, you have to save 9. 10 is the new 4. Why? Because the returns are lousy. And why is that? We're back to financial planning. We're back to that whole idea of asset allocation and that pyramid showing that the safest money is the lowest returning money. So if you put a lot of money into really safe, you're paying an enormous amount for reducing short-term risk. You're paying 9.5 to 15% maybe to reduce your risk. Does that sound reasonable? That's why traditional financial planning, in my opinion, does not really make sense. Going to the financial plans, it's based on Monte Carlo simulation, which doesn't work. It's based on looking at the past and saying the future is going to be like the past. Those are the best estimates of returns that we have. And it's based on this whole concept of reducing risk. Don't lose money, don't lose money, don't lose money. So put a lot of things into safe things. And in fact, you're giving up. You are losing opportunity funds. You're losing money. That's the way it is. That's why I don't do financial planning. I do future planning. We'll come back to that after this commercial break. Don't go away. What is future planning? Stay with me. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about financial planning. I've been talking about what my clients like. I want to talk about future planning because I don't do financial planning. I do future planning. And the assumption in future planning is we really can't know the future. All we can do is live with what it's going to be and provide a margin of safety so that if the market goes down, we have plenty of money left to take the hit if the market goes down. And if we have high inflation, we're going to have plenty of margin of safety that as inflation eats up the value of the dollar, we're going to have plenty of money to get beyond that. You know, between 1961 and 1980, the value of the dollar sank by 70%. It took 3 times as much to buy a loaf of bread or to buy a suit or to buy a TV. It took 3 times as much in terms of dollars. TVs, not so much so. Technology made a change in that. But for the same thing, it took 3 times as much to buy something in 1980 as it did in 1961. That was the impact of inflation. Inflation got into the double digits. And so when you get to that, how do you plan for that? I believe you plan for that by having a margins of safety. The market's going to do what the market's going to do. The best we can do is try to beat the market and build a margin of safety. The best thing we can do is to build such a margin of safety that if we have that downdraft in the market, that we have plenty of money that we don't have to worry about the downdraft. We know that if stocks go to zero, there's a whole lot of other problems, and you really don't care about the stock market at that point. If stocks don't go to zero, there's a recovery. So all we need to do is get through that period of time, like we did in 2008, 7, 8, and 9. And my clients were whole by 2010. So all we have to do is get through the hole. We have to have enough margin of safety to get through that period of time. At the same time, if we have a high bout of inflation, we need such a margin of safety that we have a significant additional wealth that even though the dollar will buy a whole lot less, we have a whole lot more dollars. That's what we need to do. It's very simple. It's very straightforward. It's looking at what happens if we have a downturn. What happens if we go up? It's not Monte Carlo simulation. It's not looking at past data. It's looking at where things are and what kind of margin of safety do we need. And then planning to build that margin of safety. Planning to say, today we can put away the money for that margin of safety. It's back to that old principle of living below your income. Putting away some money, saving some money. And the concept behind that was so that when a rainy day comes, you have money set aside that you can use. Concept with future planning is exactly that. Exactly that. To put away enough money that when the rainy day comes, whether it's a downdraft in the market, whether it's excessive inflation, you have enough money that you can live through that. That's what it is. That's what it is. You know, there's a game that shows how people are reluctant to lose money. It's a game where people were given $20 and they had 20 rounds. In each round, you were asked if you'd like to invest $1. And based on a coin flip, if the coin came up heads, you got $2.50. If it came up tails, you lost your $1. So the best interest was to play every single round. And out of that, you can calculate the probabilities, and I'm a mathematician, you can calculate the probabilities. There's only a 13% chance that you'll end up with less than $20, that you'll flip tails enough in 20 times that you'll end up with less than $20. But you know what? 87% of the time you end up with more than you started with. 87% more. Half the time you're going to get $2.50, and half the time you're going to lose your $1. So half the time times that, you're going to end up with an average of significantly more than you started with. 87% of the time you're going to make more than you started with. But as the experiment went, only 58% of the time did people play all 20 rounds. 42% of the time they quit. Only 40% of the time did they play after a loss. So once the tail came up and they lost $1, they quit playing. You know, you think people understand. In that game, $20 is not very much, and yet $20, a tail comes up once or twice or 3 times, people quit playing. You know, that's the concept behind the financial planning and this whole idea. Now, most of the times, financial advisors are doing quarterly reviews, and there's a step-by-step process on how it's supposed to operate. Short time ago, I was at a conference, and one of the speakers did the 7-step process. It's a formal process. Step 1 is to set the agenda. Not about small talk, not about family, not about things. It's to set the agenda. This is the correct way to do a portfolio or client review. Step 2 is to connect with the stuff of life, to connect with the nuclear family issues. What issues are going on in your nuclear family? What issues are going on in the extended family? What issues in vocational? What about recreational? What about significant pets? It's to connect with those things which can have an impact on your portfolio, supposedly. But it's also to set the idea of connecting with the financial advisor. Remember at the beginning of the program I said the idea is to sell the performance, or to sell the relationship and not the performance. That's what it was about. Step 3 is to set it with a market outlook. Step 4 is to review the performance and show the progress. Step 5 is to discuss a standard of care. Step 6 is to expand the relationship. And step 7 is to end the meeting. Notice, of all the things, very little time is devoted to the performance. Talk about the market as much as you talk about the performance. Talk about relationships as much as you talk about performance. In fact, There's a couple areas that are devoted to the relationships and family. Very little to the performance. You know why? They don't want you to know what the performance is. They don't even want to talk about it in percentage terms. They want to talk about it in dollars terms. This is what you start with. This is what you have. See how wonderful I am. That's the idea of a performance review. You know, we didn't have those when I started in this business in '86. It was buys and sells and getting paid a commission. It's only been since we've had fees that we started to give reviews. And the reviews are not about the performance. They're not about the plan. It's all about selling the relationship. That's what this is all about. You should be aware of that. You should be aware that every time you go into review, it's not about how well you're doing. It's about how well you get along with your financial advisor. It's not about whether you're going to be prepared for the future. In fact, financial plans usually only go out to age 100, and most of people will live beyond 100.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial